December 6th, 2023. When you get a big gap up and then a strong bear bar closing near its low, well, in general, the first bar of the day has a 20% chance of being the high or the low of the day. But when you get a big gap up and a big bear bar closing near its low, or a big gap down and a big bull bar closing near its high, it increases the probability that you've seen the high or the low of the day. So it's more like 30% on bar one that you've seen the high of the day already when you get the close of one, and you get big follow through on bar two. But the thing you have to notice about bar two is the price it went to, right? Bar two went 5.75 points below bar one, and it needs to go 5.5 points for traders to make a 5-point scalp, because if you're selling, you need to sell one tick below, and it needs to go one tick past your order in order to fill it. So it actually needs to go 5.5 points in order for you to make a 5-point scalp. And two went 5.75 points. So bulls or bears who sold below one were able to make a 5-point scalp during two. And then we got a doji bar on three. What does that tell you? That tells you that bears sold below one and scalped out with 5 points rather than holding for a swing. Usually, if you're hoping to see a big bear trend day, obviously we got one today. But usually, if you're hoping to see a big bear trend day, you don't really want to see bears, taking quick profits early in the day. You want to see them selling more and continuing to hold for a swing. And when you get the doji follow through on three, that's a sign that this isn't as strong as it could be. Bad follow through on four, essentially a couple dojis in a row. It's a low one below three, but a lot of bears, probably more buyers below there than sellers. Four is a double bottom with the low of two, and the neckline is the three high, but this is not a good buy. There's, a big tail, and one and two is strong enough for another leg down. Five is a bear bar closing near its low, and it's a double top bear flag with three, but I don't really think it's that good of a sell. You're selling the bottom of a tight trading range, and there's going to be support at the prior day's high. And speaking of which, in general, I thought another reason we might go down is because the middle of this tight trading range that we've been in for a little while, leave it, start over here, is around 45.75. So around 45.75 has been the middle of this tight trading range for some time now. And I was thinking that with the big gap up, you can see that's what we were oscillating around basically during this channel, was basically 45.75. That's what this whole day was centered around. And so I thought we might have to get back down to that price. Six, bad follow through for five. It looks like more traders buying the close rather than selling. Oops, did not mean to do that. And then seven, a big bear bar closing near its low. Also getting to yesterday's high, which is always an important price. But seven's not all that good of a sell. It's, essentially three pushes down. One, pull back two, pull back three. And you're you're basically selling right on support, and there's a tail on seven. So really not a very good trade. Big bull bar on eight. I thought it was reasonable to think that we were going to test Friday's close. And the reason for that is the daily chart. I thought that, the bulls who bought here, it wasn't a great idea to buy here. It was a pretty bad idea, actually, because we're so high in the trading range. However, it is a reasonable buy the close bar. So if it's reasonable to do, a lot of those traders were probably, it's essentially a magnet, is my point. And so I thought we might have to get back up to this close. However, I don't think it's okay to buy above eight. If you're buying above eight, you're buying, essentially a little bit high in a tight trading range. And even if you're buying in the middle of a tight trading range, you don't want to be doing that. And bulls get follow through on bar nine. And I think it's important that nine closed above three. So there is some credibility for the bulls. But if you bought above eight, do you really like nine as your follow through? Does it make you really happy to see nine? No, not really. It tests back in the middle of the trading range, telling you that we're probably still in a trading range. And then, you get a kind of, it's a bull close on its high, but it's not very big. It's like a fourth, maybe a third. The body is maybe a third the size of the body before. So if you're buying above eight, what you really wanted to see was another bar like eight. You wanted to see an explosive follow through bar closing up here, not, a kind of weak bar like nine. When you get a weak bar like nine, it makes traders more confident in selling the close, thinking that we're selling above it, thinking that we're probably going to test back down into the tight trading range. And that's exactly what happened on 10. Any traders who bought above eight or bought above nine are obviously going to be disappointed in 10. And, while they should get a second leg up, a lot of those traders just ended up exiting at the market, causing the big bear bar on 10. I know that 10 looks like, that big bear bar on 11. I know that 11 looks like a tempting bar to sell the close of, but you're pretty much selling what's probably the bottom of the bear channel. And this was, think about this. We got strong sell to close here, or not necessarily strong sell to close, but we got strong bear bars here. And then when it became theoretically reasonable to sell, it went sideways. Strong bear bar, it gets bought up, ends up going sideways. Strong bear bar, it's probably going to go sideways. And that's, skip ahead a little bit. That's exactly what's happening over here. When you get 25, you shouldn't really be tempted to sell it. You know that it's probably a profit taking bar rather than a bar to sell more on. Why? Because that's what's been happening all day. It's the bottom of a bear channel. It's the bottom of a bear channel, and traders are going to take profits at the bottoms of channels. I additionally thought it was important to note that if you sold below 1, your entry price was 45.9275, and which means in order to make 50 points, it has to get to 45.77.25, I believe. And if you look at this, the low of it was 45.77. Let me just make sure my math is correct. I'm not great with mental math. 45. Yeah, my mental math is correct. So we got to this low. And so exactly what's happening here is traders are taking profits with 15 points. And so you should be expecting that when you're selling, or the traders who sold below 1 are probably going to start taking profits because it's the bottom of a channel and they made 15 points. Why is 15 points important? Well, look what happened yesterday. Which, by the way, I didn't make a review yesterday, and I'm probably planning on making it, today at some point, and I'm going to release it tonight. I was just tired yesterday, and I've been making a lot of these videos, so I just wanted a little break. But if you sold below 1105 yesterday, look at your low. So it's 4581.5, right? 45.1.5, and then you have to go minus 15.5 for the 15-point scalp, which brings you to 45.66. What is this low? 45.65.25. This low is 45.66 exactly. So basically, when these bears made 15 points, they exited. And this is a big enough profit that it's a swing profit, which tells you that swing trades right now are more like 15 points and scalps are more like 5 points. So it's important to keep in mind, you have to notice that traders are taking profits at 15 points. For swings, and they're taking profits at 5 points for scalps, and there are 5-point scalps all over the place. Even yesterday, if you bought above this high, 45.67.25, you needed it to get to 45.72.75, and it got there exactly at this high on the 1 o'clock bar when it got back into the middle of tight trading range. So while this looks like a good buy the close bar, you're actually back in the middle of a tight trading range at the 5-point scalp where a lot of traders are going to be taking profits. Anyways, so that's my long-winded answer on why selling the close of 11 is not a good idea. You're going to get a pullback on 12 and 13. You can see the limit order bulls who bought below 7 and scaled in lower are going to be able to make money. Scaled in maybe 5 points lower, reasonable thing to do. They're going to be able to make money on 13, and you can see they do. Big tail on 12, big tail on 13, big tail on 14. So you could argue it's 1, pullback 2, pullback 3, and some sort of wedge on a smaller time frame. But the reality is, what you really need to notice is that this is strong enough for a second leg, and this is not a very good rally at all. So that we're probably going to end up seeing more profit taking from the bulls who bought low, looking to get out here. Additionally, I don't know. Is there a reasonable? If you bought above 9, it wasn't a good thing to do, but it was technically reasonable. And I'm not sure those traders were ever let out today. Maybe if you bought 5 points below this low, 78.25, but even those traders couldn't get out. So it's notable that the traders who bought above 9 weren't really even able to scale in and get out around break even. Usually if you take a reasonable buy, 80% of the time you're going to be able to scale in and get out around break even. 60% of the time you're going to be able to make a profit. So I thought it's notable that those traders weren't able to make money. 15, it's a low one short, and this was a strong move, but I think you'd rather wait for the market to go a bit more sideways first before selling. Follow through for the bears on 16 and 17, but big tails on the top, indicating that there's buying pressure here and not all that good. Reversal up on bar 18. It's a double bottom. It's a higher low from 12, but this isn't what you want after 3 straight bear bars and after this. Have any stop order bulls made any money yet today? Have these bulls made money? You could have made 2 points. If you bought above bar 8, you were risking 7 points to make 2 points, a 2-point scalp. Is that reasonable? No, it's not. If you bought above here, could you even make 1 point? You could. So if you bought above 9, you could make 1 point. Is that reasonable? No, it's not. So if no stop order bulls have made money yet today, do you really want to be, to try to be the first stop order bull to make money buying above 18? it's probably not a good idea to buy. That's why. 19, bad follow, or sorry, additionally 18, we're testing around the close of 11. So if you did sell the close of 11, a lot of those traders scale in maybe 5 points higher, and then they get out around break even on their first entry during 18 and with profit on their second entry. And furthermore, on the daily chart, back to what I was going to, I think a lot of those traders, they bought here, they bought more below, and they were able to get out of break even during this day. There's a 60% chance we got back to this close, but an 80% chance we got to the midpoint, and that's exactly where we got to the prior day. 19, bad follow through for the bulls. If you bought above 18, you were hoping for just pretty much the best bull bar you could get. You wanted to close above the top of the tight trading range. 18 is a double bottom of 12, so you wanted to close above the neckline, the 14 high, and you just don't get it on 19. So a lot of those traders are probably going to be exiting pretty quickly during 20. 21, a bull bar, but you're following these two bear bars, which isn't great, and there's lots of tails in here. This is probably a tight trading range, so better not to be buying high in a tight trading range, especially when stop order bulls haven't made any money yet today. 22, I had kind of conflicted feelings about 22 in the moment because it's in the middle of a tight trading range, but this is probably strong enough for another leg down. We did have 2 sell climaxes, but we might get a third. And it's probably a reasonable swing trade. If you're, this is strong enough for a second leg, and it never really went always in long. By the close of 11, it's hard to say exactly where it went always in short, but it's always in short. And it's a wedge pullback, 1 pullback, 2 pullback, 3. So it's a wedge pullback when it's always in short. Anyways, follow through on 23 for the bears, but you can see bears essentially scalped out when we got to the 12 low. So I think if you sold below 22, it's kind of hard to want to sit through 23, but some bears will, always in bears probably will. And I think that's a smart way to trade. And you can see if you sold below 21, sold below 22, the big tail is essentially your true risk. I think it actually traded up first before it went down, but if you take 2 to 1 of this big tail, that's essentially where we went to on 23. 24 pulls back, but sells off again. Good for the bears. I think a lot of times on 24, you end up seeing a bull bar and something really disappointing for the bears who sold below 22. And 24 isn't great for the bears, but it's notable that it's a bear close and still reasonably short. And I think, you get 25. I don't think it's tons of bears being super interested in selling the close of 24. I think this is more bulls dumping out of longs. And the reason being, I think it's pretty reasonable to think that you're going to get a bull close on 24 because the bears who were selling below 22 scalped out disappointed on 23, and that's what caused this big tail. And so it's reasonable to think those bears are going to be scalping out, and bulls know that, and a lot of them will buy, hoping to get a bull close. And when they don't get it on 24, they exit, and that causes 25. Now look at 25. Again, 25, kind of like selling the close of 11, not all that good, and you're selling the bottom of a third push. 1, pullback 2, pullback 3, consecutive sell climaxes. We're probably going to get a correction. And additionally, if you sold below 22, the low is 45.79.5, which means you need to get to 45.68 in order to make 10 points. Sorry, 45.79.5, which means you need to get to 45.68 to make 10 points. 69 to get to make 10 points. Jesus. And it got to 68.75, so you got 1 tick past exactly where you needed to get in order to make 10 points. And it shows here when you get 26, means that the traders who sold this close or sold below here were just scalping out with 10 points around the bottom of the channel line. And that's why you get disappointing follow through on 26. Any trader who sold the close of 25 is disappointed in 26, and all those traders are getting out around break even during 27. That's why, there were some traders who sold during these prices, and you can see as this traded down, those traders were buying back shorts. We're probably going to get a couple legs sideways to up. And it's notable that limit order bulls have been making money. So it's reasonable to think that the bulls who bought below this low are also going to make money. And that's exactly what's happening on 29. Those bulls make money. Good follow through on 30 for the bulls, but it's 1 pullback, 2 pullback, 3, 30, looks climactic. And you're still at this point at the top of the bear channel. So I don't think it's a very good sell below, or buy above 30. Disappointing follow through on 31 as expected. Any bulls who are buying were probably just wanting to scalp to the moving average. It's, not really a great idea to be buying for a swing on a day where stop order bulls, still had yet to make money. The only stop order bulls that could have made money would be if you bought the close of 28 and then you made a 5-point scalp. But is buying the close of 28 a really good idea? It's really not great. You're due for a bounce, but it's just really it's a double bottom, and it could be a final flag in a tight trading range, but it's really not all that great. It's a really tough trade to take, and if you have to take a really tough trade to make a 5-point scalp, it's really not all that good for the bulls. Disappointing, but notable that potentially market order bulls could have made money. 31, a bear bar, but not all that great. 32, anyone who bought the close of 30, disappointed. 31, exiting during 32. 33, a 4-bar tight trading range and a micro double top with 31. Or sorry, a double top with 31. I guess it was a micro double top with 32. It's a bear flag. It's a double top bear flag. So 40% chance that you're going to get a measured move down based on the height of the trading range. So somewhere down here. 40% chance selling below 33 that you're going to get down here before you get up here. But the thing about these kind of sells, these double top bear flags, is that they're usually really difficult to sit through. It's hard to sit through pullbacks like this. It's hard to sit through all of this. So a lot of times, if you're taking these sells, the traders end up getting out earlier than the profit target. Follow through on 34, but we're heading towards the bottom of a trading range. But it is, follow through. And some traders will sell hoping we're going to get big follow through. But when you don't get it on 35, those traders are concerned that this strong spike up might get a better second leg up than just 32. They start to exit, causing 36. 35 and 36, doji bars, so really not all that great. And the bull bar closing here, it's high on 37. It's a high or low. I know it might look like a tempting trade, but again, stop order bulls really haven't made much money today. And, those bulls only ended up being able to make a 3-point scalp. And the thing is, that's hindsight, obviously. But in real time, this is a tight bear channel. If you're buying hoping essentially we're going to get a trend line break. If we do get a trend line break, how far is this going to go, right? Because if it's a trend line break, it probably needs to retest back down before you get any sort of major trend reversal. So if you're buying above 37, you're probably looking at 10 bars, 2 legs up, a minor reversal, best case scenario. Your best case scenario is a minor reversal. So I don't really think that buying above 37 is all that good of an idea. I think it makes more sense to wait for the trend line break, then some sort of retest down, and then see if we can get a swing up. Follow through on 38, 39 for the bulls, but big tails on the top, really not all that strong. It seems like we're just testing the top of this trading range. And if you're a bull and you bought above 36, you're probably not thrilled with 37. Or sorry, if you bought above 37, you're probably not thrilled with 38. And you're definitely not thrilled with 39. And, it could be some sort of two-legged, one, or with down on one, up, down 2, down 3. I'm assuming, if let's look at, actually, I'm curious, 1230 to 1240 on a 1-minute chart. It's probably some sort of wedge, I would assume. 1230 to 1240. Yeah. So it ends up being a parabolic wedge. 1 pullback, 2 pullback, 3 pullback, 4. So you get 4 pushes up instead of 3. But you can see my point in that when you get all those tails, it's probably some kind of wedge, and traders are going to exit. And there's something else really notable is we haven't had any sort of higher high yet today. Lower high, lower high. You can even say this was minor, but it was still lower high, lower high, lower high, lower high. So we've had all lower highs so far today, and that actually continued throughout the whole day. Lower high, lower high, lower high. So really, we haven't had a lower high yet today, and we haven't had a higher low hold. So what makes you think that this is magically going to be the first higher low to hold, especially when we're failing to get the lower high or a higher high right now? So 40, a big bear bar. It tests exactly the 27 low and finds some buyers. Some traders are hoping, bulls are hoping that, a trend line was like this and we just broke it. And now we're getting an exact retest and we're going to get a higher low, essentially a higher low major trend reversal, but probably not. Bad follow through on 41 for the bears. But, all day, bears aren't as interested in selling the new low. They're more interested in selling the pullbacks. 42, a strong bear bar closing near its low. 1, pullback, 2, pullback, 3. So probably 3 legs down on a smaller time frame to 42. And again, selling here, you're selling essentially on the 15-minute chart, right? If it's these 3 bars, because multiple of 3, 42. 3 is a multiple of 42, right? Yeah, it is. Okay. 3 times 14, right? So if you look at this, it's a strong bear close at the bottom of a bear channel on the 15-minute chart. And all of these are strong bear closes at the bottom of a bear channel. So if you think about it that way, you don't want to be selling a strong bear close at the bottom of bear channels. That's what's been losing you money all day. Or, you could theoretically be making money doing it, but you're sitting through some pretty brutal pullbacks. So it stands to reason if you sell below this, if you really wanted to do it, you'd have to put a stop somewhere up here and just probably walk away for a couple hours because you're going to probably end up sitting through a pretty tough pullback. 43, bad follow through for the bears who sold on the close of 42, not surprising. 44, tries to, be a strong bear bar, but it gets bought up. We're in a tight trading range. Again, it just seems to be testing the bottom of the bear channel. It's notable that it seems like the bear channel is getting more shallow. Obviously, we got a big sell-off at the end of the day, but, one, pullback, two. The pullback wasn't all that strong, though. I thought this might end up being some sort of leg one, leg two day, but even it was such a strong day that even the pullback ended up being sideways down and more down slope in this case. These kind of days, they make you want to just buy above everything. All of the reversals up look good, and all of the, swings down look bad, but all of the reversals up end up failing, and all of the swings down end up working. The reason for that is because it's the market, and it makes you end up chasing it the whole day, right? So when the reversals up look good, it's pretty easy for bulls to get trapped. And when the swings down look bad, it's pretty easy for bears to get trapped out. So when you have trapped traders all day, it can trend down all day. 45, a bull bar closing near its high, but this is a tight trading range. You'd be buying above, at the top of a tight trading range, which you don't want to do. 46, bad follow through, doji bar. Another doji on 47. So we have, 4 dojis in the past 5 bars, essentially. You don't really want to be taking anything. And a bull bar on 48, but it seems like it's probably just trying to test the 39 low. If you buy below 39, this is really not what you wanted to see. But if you scale in lower, you're probably going to be able to make money because all day bulls have been buying and scaling in and able to make money. 49, a bear bar closing near its low, but this is a pretty tight bull channel. You might want to, wait, and you get an inside bar on 50. And it triggers on 51. It triggers the II, but this probably isn't a very good swing sell. I'd rather wait. And if you do sell it, you probably have to have a wider stop. The stop up here is a skunk stop because that, limit order bears have been making money selling above things all day. So, if you sell below here, you're probably going to be able to sell more higher and make money. And honestly, you'd probably be able to sell more above here or here and make money. So unless you start getting really strong bull closes, you probably don't need to get out. So failed breakout below the II on 51 and a breakout attempt up on 52. Small inside bar. It's really not a very good buy. It could be a third push up in what's probably going to become a trading range, this being the top of the trading range, somewhere up here. 53, follow through for the bulls, but it doesn't close above the 48 breakout point. If you bought above 52, you really wanted 53 to be a bigger bull bar, closing strongly above 48, and it just doesn't do that. So 53 might be more of a sell the close bar, betting against good bull follow through than a buy the close bar. And you can see you get bad follow through on 54 for the bulls, and now it's doji at the top of the trading range. It's 3 pushes up. 55, probably buyers below 54 since the doji, but we could pull back pretty deep before we get back to that low, so not a great buy below any of this. 56 is a micro double top. 54, 56, a potential swing sell, but you're right on the moving average. It's probably okay, but I think it's better to wait for follow through. And you do get the follow through on 57. I think it's okay for always in bears to get short again. Follow through on 58, and bad follow through on 59, but still okay to be short. I thought it's important that 60 traded above 59, meaning that this, once it trades above, 60 could now be the second leg down. So it could be 1, pullback 2, and 60 could be a second leg trap, especially at the bottom of a trading range. And then you get disappointing follow through on 61 for the bears. Essentially, bears know it could be a second leg trap, and they start buying back shorts. And as the market goes up more and more, traders get more and more eager to get out because they're worried that this is going to start to rally. And so they all exit, and that's what makes the big bars happen. Bad follow through though on 61. This is probably strong enough on 62. This is probably strong enough for a second leg. And realistically, any bear who sold below 57 or 58, once they see 61, if they had held, they probably want to get out around break even. And that's exactly what's happening when we get back to this 57 low during 62, and during 63 we get back to essentially the close of 58, and traders are buying back shorts. You can see that they're buying back shorts here because these were both reasonable sells, and then you get disappointment, so traders want out around break even. 64, a bull bar closing near its high, but it's right on the moving average. It's an III, sure, but that just means it's a triangle. We're probably going to need a breakout in either direction soon, and bulls really struggle to make any money today. There hasn't been a reasonable, in my eyes, a really solid, reasonable bar to buy above that has made a 5-point scalp. None of these were able to make 5 points. Bulls couldn't make 5 points here.
the only way you would have been able to make 5 points as a bull buying essentially on a stop order is you pretty much have to buy on a market order on the close of 28, and then you barely be able to make 5 points. So and that's such a, I don't even know if that's a reasonable thing to do. I'm just, that just kind of making things up at this point. So it's, pretty much bulls have struggled all day to make money. So we're on bar 64. So do you really want to buy above 64 and try to be the first, hero bull to make some money? Probably not. 65 outside down, failed breakout above, and you're getting a breakout below now. 66 follow through for the bears. At this point, we might have an outside down day. You got to think that when you see 66, the target is probably, at least today's low, but the following target is yesterday's low. And, generally when you do get an outside down day, 70% chance that it's going to close in its lower third, which is exactly what happened today. So probably, reasonable to sell below 64 as it trades below it on 65. Definitely reasonable to sell at close to 66, 67. Bad follow through on 68, but 3 bars good enough for a second leg. And then you get 69, a strong bear bar breaking out below the 43 low. 70, kind of bad follow through, but enough that we might continue down. Big bear bar on 71, and you can see we went sideways down into the close. We did kind of break out below the bear channel, and usually when you get the strong breakout below the bear channel, it's going to start to go sideways within 4 or 5 bars, and that's exactly what happened. On days like this, I a lot of times end up sitting out on days like this, especially at this point. I think with these days, I think with all days, it starts out with you're doing all the wrong things, and then you learn to sit out on the more difficult days, and then you eventually learn to trade in the direction of the more difficult days. So, 3 years ago, I'm definitely probably buying above 8. I'm probably buying above 9, getting stopped out. I'd probably buy above 18, get stopped out. I'd probably buy above 37, get stopped out. I'd probably buy above, 45 or something and just keep getting stopped out. And that's pretty frustrating. And then eventually you kind of stop taking the bull entries and you just learn that they're not as good. And then eventually you start thinking, well, wedge pullback here. We're on the top of the bear channel line. It doesn't look all that great, but we're probably at the top of the bear channel. A reasonable swing below 22. One's reasonable, but I try not to trade the first bar of the day. 33, it's a micro double top. There's a double top bear flag. There's a 40% chance that we're going to get a swing down. Probably an okay sell. Definitely an okay sell below 57 for always in bears. If you're on these channel days where you keep getting these lower highs, probably just trade from an always in perspective, and you sell 22, you sell 33, you sell 57, you sell 66, or 65 or 69, or 67. And yeah, on the daily chart, we have a bear bar, closing near its low. And it's, it's a decent looking bear bar, and it's definitely possible that tomorrow, we get whatever 30 40 points down to the moving average. And I would say the bull spike ended here, and so we might have to test the bottom of the channel 45.12, which wouldn't surprise me. But it also wouldn't surprise me if we get bad follow through tomorrow, because we've been in a tight trading range for so long that selling below here, while probably a reasonable thing to do because you're at the top of an overall trading range, you're trading against a very tight bull channel. So you have to be careful. This is probably a minor reversal. Let's put it that way. I don't think you're going to sell below this and hoping you're going to get all the way down here, or even all the way down here. If you are hoping for that, you're most likely going to be disappointed. So I'm expecting disappointing follow through here, but it's definitely enough for a second leg down. I think the best the bears can get right now is 10 bars or 2 legs sideways to down. And then we might oscillate around, so I'm still interested to see if we're going to close this gap. But I think we're going to end up going sideways and then maybe try to get some sort of reversal up. On the weekly chart, bears really would like a bear close. We've had 5 straight bull weeks so far, or had 5 straight bull weeks to the top of this channel, or this, potential trading range. So bulls hoping that we end up getting a bull close here, but they'll probably be disappointed. And yeah, that's the day.